Welcome back to the Deep Dive. Today, we're tackling a topic that came straight from you, our listener. It's a really comprehensive look at Ferrari NV. That's ticker RACE.
Yeah, this is a great one. We've got this fantastic analysis of the prancing horse, and, well, our job today is to unpack it together, right? Pull out the key insights, figure out if Ferrari really is a wonderful company, and what that actually means given, the challenges and opportunities they're facing.
Okay, let's get into it. Right off the bat, the material asks this really fundamental question, and it kind of changes how you look at everything. Is Ferrari basically a car maker, like, Ford or GM?
Right.
Or is it something totally different, maybe more like a luxury goods company, think Hermes, LVMH?
Yeah.
And the sources argue, look, the answer is absolutely crucial to understanding Ferrari.
And they land pretty firmly on one side.
Yeah.
The analysis concludes Ferrari isn't your typical car company, not at all.
Okay.
It's positioned as a top-tier luxury house that's just incredibly good at, and I like this phrase, monetizing desire.
Monetizing desire. Yeah, that really clicks. It frames it immediately, not just metal and engines, but aspiration.
Exactly that. The basic model looks simple.
Yeah.
Sell amazing performance cars people dream about. But the key thing, and you see it clearly in the numbers, is how much of their revenue, their profit, comes from these high-margin brand activities. Sponsorships, commercial deals, licensing, that sort of thing.
And the 2024 financials really highlight this split, don't they? You see total revenues up, almost 12%? You're $6.7 billion, roughly?
Yeah, 11.8% growth. Pretty healthy.
But then you look at car shipments, and they barely moved, up less than 1%, 0.7%. That massive gap revenue soaring while volume is basically flat. That is the luxury playbook, isn't it?
It absolutely is. That decoupling is key. And how do they do it? How do you grow revenue without selling loads more cars? The material points to, two main things. First, a richer product mix.
Meaning?
Selling more of the really, really expensive stuff. Those super high margin models like the Daytona SP3, the special series cars.
Okay, more pricey cars. And the second driver.
Personalization. This is huge. All those bespoke options, the unique paint colors, the custom interiors, you name it. The analysis says this customization now accounts for something like 20% of the revenue from just the cars and spare parts.
Wow. 20% just from making each car unique. That's basically selling pure exclusivity on top of an already exclusive product.
Exactly. It's high margin desire layered right on.
So this whole model, it's not built on production lines churning out units. It feels like it's built on something deeper, more lasting human psychology, right?
Yeah.
That desire for status, beauty, performance, rarity. And the sources say they've been carefully nurturing this sense of unattainability for, over 75 years?
75 plus years, yeah. And the core philosophy behind it, which apparently runs from Enzo Ferrari himself right through to the current CEO, Benedetto Vigna, is absolutely critical. It's the mantra. Always deliver one car less than the market demand.
One car less. It sounds simple, but it's profound.
It is. It's not just inventory management. It's a deliberate strategy. Engineer scarcity. And that scarcity turns the car into what economists call a Veblen good.
Where the higher price actually makes it more desirable.
Precisely. Higher price, longer waiting list. It just fuels the desire even more, which is, the complete opposite of how traditional car companies work.
Yeah, they're usually fighting on volume, squeezing margins, offering discounts.
Exactly. And look at the results. Profitability. The typical auto industry EBIT margin in 2023 was, around 7.7%. Ferrari's EBIT margin in 2024, try 28.3%.
28%?
Yeah. Their financial profile isn't like BMW or Mercedes. It's like Hermes or LVMH.
Yeah.
Pure luxury territory.
There's that killer stat in the material, too, isn't there, about Porsche?
Oh, yeah, that one's amazing. Porsche, and they're a profitable premium company themselves. Porsche would need to sell 5 cars to make the same profit Ferrari gets from selling just one.
5 to 1. That just hammers home the difference in the business model.
It really does. And that kind of sustained, massive profitability points directly to what the analysis calls Ferrari's economic moat. It's described as one of the widest, most durable moats out there, and it comes almost entirely from one thing: the intangible power of the Ferrari brand itself.
It's more than just a famous logo, isn't it? It's this whole ecosystem of value. The analysis breaks down why it's so hard to replicate.
Yeah, it's got layers. First, you have the heritage and mythology. 75 plus years of history, all tied up with the legend of Enzo Ferrari. You just can't manufacture that overnight.
Then there's the racing.
Racing supremacy, yeah. Scuderia Ferrari, oldest team in F1, most successful. The material frames this not just as like a hobby or marketing cost, but as a core, year-round global marketing platform. It connects the road cars directly to winning, to cutting-edge tech, to pure prestige.
And the third leg is that scarcity again.
Engineered exclusivity.
Yeah.
That deliberate holding back we talked about. It makes owning a Ferrari not just buying a car, but achieving something. It's a status symbol like almost nothing else.
And the way they allocate their really limited edition cars is maybe the ultimate example of this moat in action. You can't just walk in with cash.
Nope. You
Yeah.
have to be invited to buy one.
Yeah.
This is where you really feel the brand's power. The material talks about the system. It's based on loyalty, how many Ferraris you've owned before, your virtual garage. They even prefer V12 owners, apparently, and they try to stop people just flipping them for profit.
And that story about the collector who sued them.
Oh yeah, the LaFerrari Aperta incident. He sued because he wasn't offered the chance to buy one. That tells you everything, doesn't it?
Yeah.
Owning these cars isn't just a transaction. It's seen as a privilege bestowed by the company. That's incredible brand power.
And crucially, the argument in the material is that this moat isn't just sitting there, it's actually getting wider.
That's a big claim,
Yeah.
but they back it up. Look, the order book is full solid through 2026. That gives them amazing visibility on revenue and, critically, pricing power. They can likely pass on inflation or tariffs without much pushback. Plus, the boom in personalization kind of shifts the scarcity. It's not just about total cars, but about how unique your specific car is. And then there's F1. Its popularity is exploding, especially in the US, Ferrari's biggest market. It's basically free marketing, bringing the brand to whole new generations.
So it feeds itself, like a flywheel.
Exactly. The analysis calls it a self-reinforcing flywheel of value. Strong brand leads to scarcity, which drives huge demand. That demand gives them pricing power and lets them be selective about clients. This reinforces exclusivity and keeps resale values sky high, which drives massive profits. Those profits get plowed back into F1, tech, the brand, making the brand even stronger. It just keeps compounding.
The material also has some interesting insights from what it calls a scuttlebutt simulation, basically trying to get the view from the ground from customers and maybe employees too.
Yeah, looking beyond the official story, on the customer side, the tifosi, the real fans and owners, it's just pure passion. You look at forums like Ferrari Chat or Piston Heads, and people talk about these cars like art. They rave about the design, the driving experience, the sound of the engine. It's always the sound. There's this real feeling of being in an exclusive club, a family.
Even the complaints reinforce it, you mean?
Kinda, yeah. The complaints often focus on tiny imperfections, things you'd only notice if you expected absolute perfection from $1 million car. It sort of underlines the elite status.
Okay, that's the customer view. What about inside the company, the employee perspective?
Well, that's where it gets a bit more nuanced, according to the anecdotal stuff online referenced in the material. Officially, Ferrari talks about integrity, excellence, passion. They have things like equal salary certification, wellness programs. But then you see comments on forums suggesting it can be a really high-pressure place, maybe even toxic sometimes. Concerns about decisions being too budget-driven, even one account calling corporate an objectively awful place to work.
That's quite a contrast. How does the analysis square that?
It floats the idea of it being an ultra-passion-based niche job, meaning people want to work there so badly, because it's Ferrari, that maybe there's a passion tax.
So passion tax.
Yeah, like the passion compensates for some of the downsides of the job. But the material flags this as a potential hidden risk, right? If the culture focuses too much on budgets over creativity, over innovation, could that lead to talent drain long term? That's something to watch.
Right. A potential crack in the fortress if not managed. Okay, so powerful brand, powerful business model, some cultural questions. Let's talk leadership and the financials. The CEO, Benedetto Vigna, came in late 2021. His background's important, isn't it? Physicist, tech guy, an outsider.
Yeah, the outsider perspective is presented as a real plus. His philosophy, as described, is about fighting complacency, that line, success can be the enemy. He's trying to bring in the faster pace of tech, more collaboration, an ecosystem, not ecosystem idea. And he seemed to have this real owner's mindset, respecting the clients and the capital.
And that thinking seems evident in how they're tackling the biggest challenge, the shift to electric vehicles.
Absolutely. The strategy laid out is very deliberate, multi-pronged. They aren't just jumping feet first into EVs. They're still investing in internal combustion engines, hybrids, and full electriators. And the key move seems to be developing the core EV tech deference, the batteries, the motors, in-house. They built that new e-building for it. It looks like a measured, long-term play to control their own tech destiny.
And does their track record with money back this up, capital allocation?
It seems very rational, very shareholder-friendly, according to the analysis. They invest heavily in the future. Look at the CapEx, almost €1 billion in 2024 for things like that e-building, while returning basically all the excess cash to shareholders.
You got the numbers there.
Yeah. For fiscal year 2024, they generated over $1 billion in industrial free cash flow. They spent about $581 million on share buybacks, paid out $440 million in dividends. That totals $1.021 billion back to shareholders, almost exactly matching the free cash flow they generated that wasn't reinvested, around 99.4%.
That's serious commitment to returning cash. And the material notes they haven't done any big, risky acquisitions either.
Right. Seems like disciplined capital management. And again, Vigna's tech background is seen as an edge for the EV shift. He gets hardware-software integration. By developing their own EV components, owning the stack, as they say in tech, they might be able to create a truly unique Ferrari EV experience and avoid just using generic parts like some others might. Differentiation is key.
Okay, so the leadership seems focused, the capital allocation disciplined. This leads to the financial fortress idea mentioned in the sources. The numbers really back up the quality story.
Totally. An earnings machine is the phrase used. The analysis points to this almost steady climb in revenue, profit, EBITDA for years, even through shocks like the pandemic. That resilience comes partly from serving the ultra-wealthy who are less affected by downturns.
And the specific quality ratios, they look pretty stunning in the 2024 data.
They really are. Let's hit the highlights. ROIC, return on invested capital. For 2024, it was 26.0%.
26%.
Yeah, that's world-class. Way above their cost of capital. It's maybe the single best quantitative sign of a truly wide moat and a business that creates enormous value. Most car companies are happy with low to mid-single digits.
Okay. What about converting profit to cash? Free cash flow conversion.
That was 67.3% in 2024. Now, the material rightly points out that's not like a software company hitting 100% plus ILA, because Ferrari does make physical things and invests heavily. But for capital-intensive manufacturer, especially during a year with massive capex like 2024, converting 2/3 of net profit into free cash flow is really strong. It shows the earnings quality is real.
And the balance sheet. Debt levels.
Practically zero net industrial debt. The ratio of net industrial debt to adjusted EBITDA at the end of 2024 was just 0.1x. It's negligible. That gives them incredible financial flexibility, a huge safety margin.
So you put it all together, the luxury model, the brand, the management, these financials, and it really does look like a fortress. High margins, high returns, self-funding its future, incredibly strong balance sheet.
Yep, the quantitative proof matches the qualitative story.
Which inevitably brings us to the big question the analysis tackles next.
Okay, it's a wonderful company, but is it a wonderful investment right now at this price?
And here the material draws a clear line. The market knows Ferrari is great. There's no secret here. It's described perfectly as a wonderful company trading at a demanding price.
What are the multiples looking like now? The source mentions mid-2025 numbers.
Yeah, PE around 51 times earnings, price to free cash flow around 65 times. EV to EBITDA near 38 times. These are hefty multiples.
How do they compare historically?
Well, the PE is a bit above its 5-year average, which was already high, around 48x. It's definitely expanded since the lows of 2022. And the PFCF and EBITDA metrics are pretty much at the top end of their historical ranges.
So what's the implication of that? Paying over 50 times earnings.
It means the market isn't just pricing in the past success, it's pricing in continued near-perfect execution, especially navigating this EV transition flawlessly. There's very little margin of safety baked in for anything going wrong, a slip-up in execution, a macro downturn hitting luxury spending, anything. So for someone looking for a value,
the conclusion of the material is pretty clear. It's probably a fair price, reflecting the quality, but it's not obviously attractive from a value perspective. It's the kind of business you'd love to own, but ideally you'd want to buy it cheaper, maybe during some market panic or if there's some temporary bad news.
the market has basically done its job, re-rating it from a car company to a luxury company, multiple over time.
Yeah, that re-rating was logical. But there's always that warning about glamour stocks, right? Where investors get so excited about past performance, they extrapolate it indefinitely, pushing the valuation way up. Ferrari is kind of the definition of a glamour stock right now. Like the saying goes, if it's in the news, it's in the price. Everyone knows the quality story.
So the risk isn't that the company implodes.
No, not really. The risk is simpler. It's a great asset that might not be a great investment at this specific price. All the good news seems factored in. That creates asymmetry. Bad news could hurt the stock a lot more than good news could help it from here.
Okay, let's look forward then. Where does future growth come from if not selling significantly more cars?
Right, the analysis is clear. Growth comes primarily from increasing the average revenue per vehicle.
How do they pull that lever?
Two main ways, according to the sources. First, price and product mix. Keep pushing prices up where they can and keep shifting the sales mix towards the more expensive models. The Special Series, the Icona range, that upcoming F80 hypercar everyone's talking about.
And the second lever?
Personalization. Just keep going deeper with those bespoke programs. More options, higher price tags for uniqueness. Analysts apparently expect this strategy to keep revenue growing at a solid clip, maybe 9–10% a year, even if unit sales stay relatively flat.
Okay, that's the plan. But what about the real, serious, long-term risks? The kind that could genuinely damage the business permanently?
The analysis flags a few, but one stands out above all others. Failure of the EV transition. This is framed as the single most significant risk.
And it's not just about the technology working, is it?
No, that's the crucial point. It's a brand risk, an experience risk. The whole Ferrari way, the essence of the brand, has always been so tied up in the feeling of the car, dominated by the engine. The sound, the vibration, the raw mechanical connection. If that first all-electric Ferrari launching 2025, hitting roads late 2026, maybe if it doesn't deliver that same kind of emotional connection, if it feels, well, generic, like a soulless appliance, as the material puts it.
Then it undermines the core differentiator.
Exactly. It could permanently damage what makes a Ferrari special in the eyes of its most important customers. That's the existential threat.
Are there other major risks highlighted?
Yeah. Brand dilution is always there.
Yeah.
The constant pressure for growth could tempt future management to chase volume, produce too many cars, or maybe misuse the brand on lifestyle stuff. That erodes scarcity, erodes exclusivity.
Wow.
The material mentions they capped the Purosang SUV at 20% of volume, which shows they get this risk now, but it's a perpetual tightrope walk.
And regulatory risk. Bans on combustion engines.
That's the other big one. Regulatory banishment. Outright bans on selling new ICE cars, like the EU's 2035 target. That's a massive headwind if the EVs aren't a runaway success. Now, maybe Ferrari's low volumes get exemptions, but you can't rely on political favors forever. It's a risk.
So this EV shift, it's described as a real double-edged sword.
That's a perfect way to put it. Huge risk, huge opportunity. The risk side is clear, failed to capture the soul, damage the brand, but the opportunity side is also fascinating. EVs are software heavy. With Vigna's tech leadership and the in-house development, Ferrari has a chance to create a uniquely Ferrari EV experience through code.
How so?
Think sophisticated software controlling torque distribution, maybe creating haptic feedback that mimics engine feel, designing unique, emotionally resonant soundscapes. If they nail this, they could build a new kind of moat based on this tightly integrated software and hardware, something competitors using off-the-shelf EV parts can't easily copy. High risk, potentially very high reward.
This complexity really calls for that second-level thinking the material talks about. What's the surface-level view, the market consensus?
Well, consensus seems overwhelmingly positive, right? Ferrari, amazing quality, super wide moat, luxury status, premium price justified, confidence they'll nail the EV transition. Analyst ratings lean towards buy. That's the first level take.
And how does this deeper analysis diverge?
It agrees on the quality, absolutely. But it diverges sharply on the risk assessment, particularly regarding the valuation. The core argument is that the market might be seriously underestimating the binary nature of the risk in the EV transition.
Binary meaning it either works spectacularly well or it could fail badly.
Something like that.
Yeah.
What's the potential blind spot?
Yeah.
It could be a narrative-driven assumption. It's Ferrari. Of course, they'll make an amazing EV that feels like a Ferrari.
Yeah.
There's an implicit belief that the magic is just automatically transferable.
But the second-level thinking challenges that assumption head-on.
Exactly. It says, wait a minute. Translating that incredibly complex multisensory experience of a high-revving V12, the sound, the vibrations, the whole mechanical theater into silent electric motors. That is a profound challenge. It's not guaranteed, not even for Ferrari. There's a real, non-trivial chance they might not get the feel right for their core audience.
And if they don't, if that first EV disappoints the faithful,
the consequences could be severe. It wouldn't just be one failed product. It would call into question the very essence of the brand. What is a Ferrari if it doesn't have that engine soul? That could lead to a permanent impairment of the brand's mystique and, logically, a dramatic structural derating of the stock's valuation.
Yeah.
You could see that 50x plus multiple compress sharply, maybe down towards the 15-20x range, typical of a really good but still conventional high-end automaker.
So the deeper insight is the market's price reflects seamless success, but doesn't seem to be adequately discounting this very real risk of potential brand identity crisis if the EV transition stumbles on that emotional connection.
Precisely. An investment today at these levels could, in hindsight, look like a huge mistake if it turns out the moat was more tied to the combustion engine than people realized. You'd be paying a luxury price for a business that might risk becoming just a very nice car company again in terms of valuation.
Okay, let's try to pull this all together. The material synthesizes this into a core investment thesis summary, like a one-pager. What are the key points on the bull side? Why own it?
The bull case rests on that seemingly impenetrable moat brand, heritage, scarcity driving pricing power. The superior luxury economics, fantastic margins, high ROIC, resilience, the fortress balance sheet, and what looks like rational stewardship under Vigna low debt, returning cash.
Yeah.
And that high visibility growth coming from the backlog, the shift to pricier cars, and more personalization, not just unit volume.
And the bear case. The reasons for caution.
The main points against are the demanding valuation, price for perfection, little safety margin. That huge existential EV transition risk we just discussed, can they transfer the brand's soul? The ever-present brand dilution risk if future management chases volume. And maybe that passion tax culture risk, could internal issues eventually impact innovation or talent retention?
We've certainly covered a lot of ground, really digging into Ferrari's business, its finances, its future, all based on this excellent material you sent in.
It's a fascinating case study, isn't it? An undeniably brilliant business, incredible strengths, iconic status, but as the analysis lays out, trading at a price that demands a lot, while facing a technological shift that's about much more than just technology. It's about the very identity of the brand. It's a pivotal moment.
Which leaves us with a final thought to chew on, maybe challenging the easy assumptions. The material implicitly asks this. For 75 years, the roar and feel of the engine has been the soul of Ferrari. Can that unique magic truly survive, maybe even thrive, when the car goes silent? What parts of the Ferrari way aren't about the engine? And is that enough to carry the brand and its premium valuation into an electric future?
That's the multi-billion euro question, isn't it? Something every potential investor needs to grapple with.
Absolutely. Well, thank you again for providing such great source material for this deep dive. And thanks to all of you for joining us. Keep digging, keep questioning, and we'll see you next time.